Good afternoon, everyone. It's a pleasure to be with you here today. Talk about my favorite subject. We have come a long way with this company, and I was just thinking about it this morning when we were listening to some presentations from some very small exploration companies, their market capitalization $4 or $5 million. You know, I have a lot of sympathy for those guys. I know what it's like to be in a very bad market where there's not much investor interest. You're working hard, you've got some great projects, and you've just got to be determined. You've got to stick at it. In 2001, that's where we were. We had a market capitalization of less than $1 million, and we had an option to buy a project called Mulatos. 2001, for me, doesn't seem to be that long ago. Yet here we are today, and the company, it's got 4 producing mines, 500,000 ounces of annualized production at the moment, a great growth pipeline, a great balance sheet. You know, we've genuinely achieved our objective of becoming a mid-tier gold producer, and it's a market right now that isn't necessarily rewarding counter-cyclical behavior. We've done most of our growing since the market's turned down. In 2014, we were a company with 1 producing mine, roughly 150,000 ounces of annualized production, less than 2 million ounces of gold reserves, but a great balance sheet. We had 480 million cash or so. So here we are 5 years later, we have 500,000 ounces of gold production and 10 million ounces of gold reserves. So we've grown in a tremendous way over the last 5 years. Mind you, our market capitalization isn't much better than what it was then. And that is clearly a sign that we're still bouncing along a market bottom. So for those diehards that are on a beautiful spring afternoon in London, 3:30 in the afternoon, are here to hear a gold story, I commend you all. I know it's not what the common interest of the investor is right now. It's everywhere but gold right now, and for some of us, it's frustrating to watch gold lock in this very tight band it's been in for several years now, and the U.S. dollar just continues to party on. If they get a trade agreement with China, well, that's bad for gold. But if they don't get a trade agreement with China, that will be bad for gold too. So that's sort of the market that we're in at the moment. We've managed to really hit our numbers for the last 3 quarters, and that's very important in the kind of skittish market that we're in. We're trying to do a lot as a company at the moment. We've got about a $300 million capital budget this year. We're building things, and primarily the biggest thing we're focused on is building out the lower mine development at Young Davidson. And there's been a couple of little hiccups along the way. I mean, I characterize them in general as relatively modest problems, but there's no such thing as a modest problem in a bad market. In a bad market, effectively, any problem is a serious problem. So we saw some very big volatility in our share price last year. We've recovered that to some extent, having had a very good third and fourth quarter in 2018, and ultimately achieved our production guidance. We had a very good first quarter, hitting 125,000 ounces of production, costs all in line. Capital development is right on schedule where Young Davidson is concerned. We'll effectively, we're right on track to be changing over that mine in the first quarter of 2020, and the whole second half of 2020 will be operating from the lower mine, which is very exciting. For those of you who pay any attention to Alamos at all, you'll know we made the terribly mad thing. We acquired a gold mining company. I don't know, it seemed like a good thing to do. Richmont Mines had been working on a project called Island Gold. Island Gold has been an unfolding discovery, slow motion discovery, I call it. The ore body kept on getting bigger and the grade getting better, and if you were paying attention, it was really hard to miss. Of course, this isn't a market that was paying that close attention. So what were we dealing with here? Well, when you're doing exploration on a very limited budget, and you're trying to prove up mineralization at 800 meters depth, you can only go so fast. It takes basically 30 days to get a drill hole down to depth. And they did a credible job of building up their reserves while they were mining, but we were able to go at it harder. And I think in the 15 months that we've owned that, we've been able to establish that we've got very good value there. Mulatos, the foundation asset of the company, it had 7 years of production life when we started mining. We've been mining there 15 years. We still have another 7 years to go. It's just been a tremendous asset for us. We were paying a 5% royalty up until recently. It was capped at 2 million ounces, and we delivered our 2 millionth ounce of production. And that was a glorious day for us all. That's about $65 an ounce we save going forward, not paying that royalty. We also operate the El Chinate mine. It kind of came along for the ride when we merged with Arico. It's managed to make $17 million in free cash flow since we acquired it. That's a miracle. I didn't think it would do that well, but it did. And now we've closed down mining operations there, and we're doing residual leaching, and it's probably producing more cash flow for the company than it produced for anyone at any other time in its mine life. So it sometimes goes that way. So I'm going to talk about each of those assets, and the first I'll talk about is Young Davidson. They did something kind of curious at Young Davidson that you don't typically do in the Canadian gold mining industry. They drilled it pretty hard. They proved up roughly 15 years of production before they decided to transition into development. But in order to prove up an ore body like this, it takes quite a bit of time. So effectively, they decided to build and operate from the mid-mine level and generate cash flow and use that cash flow to develop the rest of the ore body. And that was a tricky thing to do. It was a great plan, but it didn't count on a big downturn in the gold price. And it was just getting tougher and tougher for them as Arico to develop a whole mine. But there we were sitting with this big balance sheet, no debt, and we were keen on getting into mining in Canada, and we were keen on a project like this. It had the long life, based on a big reserve. It had the potential to be a low-cost mine once it was fully kitted out, and those are rare things to find. They're really the unicorns to find in our industry. Every gold mining company wants one, a long-life, low-cost asset that can generate free cash flow looking 15, 20 years out. That's what Young Davidson represented. When we took it on in 2015, we closed the deal in the summer of 2015. 2020 seemed a long way off. It doesn't seem so long way off now. We're basically 3/4 away from completing this construction project. We've already lowered the MCM shaft down to shaft bottom. We've been doing all the underground development using that. We've finished the raise boring of the North Gate shaft, and we're just left with a little block in between that you don't knock out until you're ready to join the upper and lower mine together. And we're just about finished ramping down to the 1,500 meter level as well. So we're well on our way, and we're right on schedule to get this all finished. Talk a little bit about Island Gold. If you look at the 2016 bar chart on the left-hand side of the screen, you'll sort of see what we were looking at when we bought it. And notice the reserve at 750,000 ounces. It's kind of small, especially when we stepped up and paid them 800 million Canadian dollars going into that transaction anyway. It was an all stock deal. That seemed like a lot of money for 750,000 ounces of reserves. But in fact, what we had done, having taken apart their block model and rebuilt it ourselves, we determined that big inferred resource that they had, it was going to all convert. They had been converting it over 3 consecutive years. Everything that they went for, every ounce of inferred resource turned into an ounce of reserve. Now that's remarkable, because almost everything that we look at, it doesn't do that. I would say 90% of the projects that we look at do not live up to their billing. Even if they're 43-101 compliant and so forth, when you look at it hard, you'd be lucky if 60–70% of that resource is going to actually stand up. Well, here's one that actually exceeded our expectations. And when we looked at it, we thought, this isn't a 750,000 ounce ore body. This is like 1.5 million ounce ore body, and it's going to continue to grow. But we've hit it pretty hard since we closed the acquisition of that mine in November 2017. And you can see by now in the 2018 bar chart, we've taken everything up, whether it's inferred resources, indicated resources, or reserves. Reserves are now sitting over 1 million ounces. Inferred resources are over 1.5 million ounces. Grade is up 12%. I mean, this is actually absolutely exceptional. Generally, when you see a reserve grow, it's typically at the expense of the inferred resource. You've reduced one and you've increased the other, but we're effectively adding ounces across every category and improving grade as well. So everything that we expected this mine to evolve into is happening, and we're not thinking about it as a 7-year mine with 100,000 ounces of production a year. In fact, we've already upgraded throughput here to 140,000 to 150,000 ounces. That's our guidance this year. We're currently mining at about 11 grams. It's an ore body that's going to be around a long time. We're investing in it now as if we were going to run it for at least 15 years. And we continue to drill this year. We have another $20 million exploration budget this year. And we're still adding ounces. And in fact, some of the most exciting holes that we've ever drilled, we're publishing those right now. If you look back at our recent news releases in this western plunge, for example, which is on the lower left of the section on the right side of the screen, we took a 200-meter step down plunge, and we hit one of the best holes we've ever pulled. It was basically 5 meters of true width, 47 grams. And then you'll notice, I really pointed out without a pointer, but it's inside the green box. There's a new drill hole that we published, and there was no hole on either side of it for 250 meters. And we decided to put that hole right between those two zones because the plan going forward is to drive a drift over that way so we can drill that zone from underground mining methods. It's cheaper to do it, and it's faster to do it. But before you drive a drift over there, it'd be nice to know if you're drifting into something with potential, other than just a big inference. But we drilled that hole, and again, we hit about 5 meters of close to 50-gram material. So it was just exceptional that the ore body these plunges are so consistent and so predictable that the geologists actually have the guts to take a 200-meter step down plunge, and they're successful in getting it because the ore body is that predictable. Those are two remarkable facts. Just switching to what we're doing in Turkey, because Turkey, every time you talk about Alamos these days, you think, oh, we were doing something in Turkey, and Turkey's a big problem. Well, we have come a long way in Turkey, and it hasn't been such a big problem. We weren't supposed to get any of our permits, but we have all of them now. We have our environmental permit, our GSM permit, our forestry permit, and now the operating permit. And you can see from the photograph here, the upper photograph shows the area where we're going to begin our excavation starting in June. We're actually mobilizing to site now. The trees were all cleared last year under our forestry license. The photograph to the bottom shows a big water reservoir that we're developing in conjunction with the Turkish Water Authority called DSI. It's the first public-private partnership that the Turkish government has undertaken to build a water reservoir. And it's going very well. It'll be finished by September, which is time for the fall rains to come. And we're going to have plenty of water captured behind the reservoir by the time we're ready to draw on that water, starting operations in the second half of 2020. The project has a 44% internal rate of return, and that's assuming a Turkish lira of about 3 to 1. It's currently 6 to 1. So this is a project with incredible economics. All-in sustaining costs roughly $400 an ounce, or actually under $400 an ounce. It'll generate $100 million of free cash flow in each of its first 3 years. In other words, it'll pay back the $150 million capex in a year and a half. It's really an exceptional project, and even if you did perceive Turkish risk to be exceedingly high, I mean, I really think it's been somewhat overplayed at that point. But even if you did, economics of this quality are hard to come by anywhere, and I think we are wise to continue moving this project forward. It'll take us up over 600,000 ounces of production by the time we're done. So with the foundation of our North American production, which we'll maintain at least 500,000 ounces going forward, we can start to build on that with this very deep pipeline of projects. Crosley, Ada, and Chamier, which all have their environmental permits. Crosley, which is fully permitted now and in construction. We won't start on the other two Turkish projects until we're generating free cash flow in Turkey. We also have a project in Manitoba called Lynn Lake, working on a feasibility study there. Island Gold, we continue to explore. Mulatos, we continue to explore and find things. We're actually building a mine called Cerro Pelon that we found about 5 years ago. It'll be in construction. It'll be in production towards the end of this year. And then we have a project in southern Mexico called Esperanza, which is now coming back into view. The new government of Mexico, despite what you might have heard during the time of the election, they are incredibly pro-mining. And while I was at the Merrill Lynch conference last week, remarkably, I was contacted by the Deputy Minister of Mines, who was very keen to discuss that project with us. They want to see us move it forward, and they're willing to help us out in any way they can. So, you know, this deep pipeline of projects, a balance sheet with which to develop it, you know, that's putting the company in pretty good stead. And I think that it makes a very compelling case for acquiring shares at these prices. And I have been doing so. I know it's one thing to stand up in front of a bunch of investors and tell them, you know, you ought to be buying my stock, but I have been buying it, all my management team's been buying it. We have clearly drunk the Kool-Aid, and I think you want to be investing with a management group like that. We have a long-term track record for providing shareholder returns. I mean, it's somewhat obscured because we inherited the Orico books when we did the Alamos Orico merger in 2015, but going into that merger, we had a 5-year track record of 11% return on invested capital. And that is something that you hear the industry criticized for quite heavily, and somewhat deservedly. If you look at the share price since 2003, when I became CEO of the company, it's basically returned about 12% a year over that period of time, which has more or less outperformed gold and the S&P Global Gold Index. So we're not used to being in the penalty box as we are now. We've typically traded at a premium, and we've grown this company, as I said, from a little exploration outfit with not many prospects as the Vancouver Stock Exchange died under our feet. You know, here we are 20 years later, and we're a mid-tier company and every bit as enthusiastic about its future as we were when we started. So with that, I want to thank you very much for giving me a few minutes to talk about Alamos. Have a good afternoon.